joined by Mr. Amur S. Lakshminarayanan, MD and CEO at Tata Communications, and Mr. Ramnarayan. Thank you, Lakshminarayan, pardon me. Thank you so much for joining us on the show. Let's talk about your earnings for the quarter that went by. Now, your revenue growth was up by 3% sequentially. What factors do you think has contributed to this performance? What can we expect in Q1 of FY26? And if you could share your revenue outlook with us for over a longer period of time as well.
Hi, good morning. Yes, we have reported a very good set of growth numbers this quarter. As you called out, the quarter-on-quarter growth has been very good. Our digital revenues for the full year has grown over 29%. So we are very pleased with the growth numbers. But to the question on what are the factors that contributed to the growth, we had actually called out earlier this year in Q1 and Q2. We had some very good order bookings and deal wins that we had reported. And some of that is translating into revenues this quarter. So that is the reason. We have had growth all around on a Q-on-Q basis, almost on all fabrics, be it network, cloud, and security. Our media business on a quarter-on-quarter basis has delivered very good growth as well. And similarly for our interaction fabric and IoT fabric. So all the fabrics have grown well. Similarly, if I look at the regions, both the India regions and international regions have done very well this quarter. So that is overall performance for this quarter.
Very good morning, Mr. Lakshminarayanan. This is Shrishti also joining in. But when we look at your EBITDA number, that has been a bit down sequentially, and the margins have contracted a bit. But to help us understand that what led to this particular pressure, and how do you plan to protect your margins going forward, and what's the way forward?
Sure. In fact, we had called out 3 years ago when we launched our Reimagine strategy in 2020. Our first goal was to strengthen our balance sheet and get our financial metrics right so that we can invest into the business. And that is what we did for the first 3 years, strengthening the balance sheet, generating cash flow. And then we have been on the investment mode, both organically and inorganically. And particularly when we did the 2 acquisitions, the major ones, the switch in the US for our media business, and Kaleyra, again, in the US, but a global business that we invested in our interaction fabric. Both these investments, the companies that we invested in and acquired, were generating negative EBITDA. And therefore, if you take out these 2 acquisitions, our rest of the business is still operating in the range of EBITDA margins that we said we would operate in, which is 23% at the moment. And the acquisitions are dragging down. We are executing on all the synergy programs, the revenue synergies and the cost synergies. And they should start to play out in the coming quarters. So that is the reason why we are saying that we are quite confident of getting the margins back to the 23 to 25% range in the medium term.
Okay, so that's the outlook on your EBITDA front. But sir, also help me understand your segmental performance. Let's start by talking about data services. This continues to be the growth engine, a 9.8% sequential growth coming in. So very good show from this segment. Help us understand what is driving this momentum and what's the pipeline looking like for the next quarter. Do you believe this 9.8% sequential growth that you've seen for data services is also sustainable going ahead?
Some of the deals are a bit lumpy, but again, when I said that in the first 2 quarters of last year, we had good deal wins, we have reasonably good visibility into Q1. As you know, we don't give any guidance on the numbers. And also, given the macro conditions, we are not quite sure how it is going to pan out in the subsequent quarters. But the indicators that we are happy about is our funnel addition last quarter has been quite healthy. Even though the number of large deals added to the funnel is somewhat less, but the overall deal additions are good. And the decision-making, particularly, I've been calling out decision-making in our business, particularly when we shifted our focus to large deals, had slowed down. That's more a kind of question of macro as well as the company getting used to the large deal cycles. So I wouldn't attribute particularly to any macro conditions on the slowness of decision making as yet. So we have good visibility for Q1, but beyond that, we just have to wait and see. The investment that we've made in all our fabrics is resonating with our customers. Our million-dollar customers are looking up, and so on. So all the matrices are looking quite good for us.
But when it comes to your voice solution and the transformation services segment, they have actually reported a double-digit decline sequentially. But just if you can help us understand that, is it a temporary softness, or are you witnessing a bit of a structural change here?
On the voice, it's been going through a very structural change for more than a decade now. And it's been declining anywhere between 10 to 15% in the wholesale voice, because we are more in the wholesale voice business. The voice that we do in our collaboration business is part of the digital portfolio, which we power Teams and Cisco and others. That is part of the digital business. But the wholesale voice has been on a decline for a very long time, and which we have called out, which is why we are saying that our data revenues now is a majority of our revenues, right? So that has been structurally declining. So there is no surprise in the decline that you saw in this year on the voice front. But the data is overall growing very well, and that is where our focus. Much of the strategy that we talk about is relating to the data growth.
Okay, so that's the take on what the outlook is going ahead, and also positive to hear that you're expecting to maintain margins between 23 and 25% going ahead in the future as well. But help us understand, what are the key growth engines for Tata Communications going forward? Is the pivot more towards digital platforms, cybersecurity, or would it be towards unified communications?
See, when we talk about a digital fabric, we have 4 components in the fabric. One is what we say is the next generation connectivity, where the drivers are going to be people moving to the cloud. How do you connect to the cloud like a SaaS platform? Have a SaaS-like platform to connect the cloud, and that is going to be a major driver for growth on the network side. And people have to transform their networks, so the overall transformation of the network, cloud connectivity, these would be the major drivers for the network business. The second area is about cloud and security, where we just launched our Vayu Cloud a few weeks ago. And there, we have a very unique proposition that we are the only player we can offer a unified solution right from the network to infrastructure as a service and GPU as a service. And on top of that, we have got our AI Studio, which allows the customers to experiment with AI and deploy at scale at the best price performance that they can get. So that would be a driver in our cloud business. The security business has done very well. We have been winning very large deals. One on the threat management side, where we implement SOC and manage the security for our customers. And the second also on the network security, we have ramped up our network security with a lot of very good capabilities, and that is growing as well. So those would be the drivers on the cloud and security unit. The third on the interaction fabric, the drivers of growth would be as people move away from or expand the channels from SMS to RCS and voice and others. That would be one driver. And the second driver is as we launch more capabilities above the channels to orchestrate more intelligently these channels, to orchestrate the customer journey, to deliver actually a better experience with agentic AI, where our B2C customers can be more targeted to their customers. And similarly, on the other side, the after-sales service part, again, we can implement agentic AI capabilities, which is what we call as our software layers on top of the messaging platform that we are building. And we launched the Kaleyra AI. So that would be the growth driver on the interaction business. And lastly, we have the IoT fabric, where the drivers of growth is essentially how we are helping large auto OEMs for intelligent connected vehicles programs and that would be the growth driver in that space. So these are the major growth drivers. And media, of course, more and more live events. We are carrying a lot of live sports events, live events across the globe. And as that number of live events grow, our media business would also grow. And as we have seen in this quarter, there has been a very healthy growth.
And lastly, Mr. Lakshminarayanan, given that the US export restrictions on GPUs and the broader trade tensions around, how is the company managing its AI compute infrastructure? Help us understand, are there any potential risk to your NVIDIA partnerships due to the evolving US trade policies, and what are the key trends you are observing in the enterprise AI spending?
First, the question on the trade and tariffs. We move data around the world, and that is not tariff yet, so we are okay. But having said that, the direct impact is not there for us. The indirect impact is our customers feeling the pain of all these, and therefore there'll be some caution in their spending, and that would be the indirect impact that we would feel. So that is something that we are waiting and watching. We don't see any direct immediate reactions from our customers as of now, but we have to wait and watch to see how the situation turns there. On the question on our NVIDIA partnership, yes, we have a great partnership. We are an NVIDIA certified platform. The Vayu Cloud that we've launched with the GPU and AI Studio that I said, we are the first in India to have a liquid cooled platform, which means that we are going to be a lot more efficient, energy efficient, and the AI Studio is going to make our customers develop, experiment, and deploy at scale very quickly. We don't really anticipate tariff-related issues there because AI adoption in enterprise is at a very early stage now. Most enterprises are experimenting. The way I visualize is our customers are going to struggle with two sets of problems. One is the macroeconomic challenges because of the tariff war and what they should do about it. And the second is we have been saying that all enterprise customers are moving at hurtling speed into what we call as a hyper-connected ecosystem world, which is driven through all these new technologies, including AI. And in that new world, our customers have to think about how do they invest, how do they prepare themselves for that future of hyper-connected world. And therefore, they are left with these two conundrums. In the AI space, they are in the experimentation phase. We are working very closely with our customers to see that they can come and experiment on our platform. They will have the sovereignty of data. They will have the sovereignty of the intelligence of the models that they train. And we can help them to deploy at the best price performance. So that is what we are offering to our customers.
All right, Mr.